Gold has never made a major low or a major high going to sleep. Nothing that gold is doing right now that is even near levels that if it broke would indicate, oh, it's over. We're not even near momentum structures. And again, whenever gold tops, you can always look at a momentum chart and see, oh my gosh, we just broke something very clear. Therefore, any pullback you see in gold is merely intra-trend.
In today's news recap, silver in correction mode after the FOMC meeting. Silver has entered a notable correction phase after months of sustained upward momentum. The precious metal has maintained a clear uptrend on higher time frames with consistently higher lows and higher highs, demonstrating resilient strength throughout most of 2024. However, as prices approached the psychologically significant $40 resistance level, selling pressure intensified, triggering the current pullback. The correction phase is most evident on shorter time frames, particularly the 8-hour and 4-hour charts, while the longer-term bullish structure remains intact on weekly and monthly charts. This dichotomy between timeframes creates both challenges and opportunities for traders navigating silver's volatile price action. What we're seeing in silver is a classic technical correction within a broader bull market structure, notes veteran precious metals analyst Mark Thompson. These pullbacks are healthy and often set the stage for the next leg higher once excessive speculation has been cleared from the market. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Central bank is the chief firefighter. Has to be. I mean, it comes in to save the government debt, which saves the government. It has to. So central government policy and central bank policy here and elsewhere, no doubt, will have to shift to more monetary excess once again, even more than they've done regularly. There's always monetary excess, growth in the money supply, artificially low price of money, interest rates. But when this kind of accident lands in their lap, that's when they have to do something fairly dramatic, because it's a huge time bomb. It's not a little one. And that creates further monetary distortion. What drives gold? The ongoing decay in the money units, the real value. And that will be a facilitator to more or less fuel inject the gold uptrend to more vertical manner. So that's why we tell our subscribers, don't just look at gold, look at the stock market, look at the bond market. Look at the dollar, which is now, and by our metrics, we turn bearish at 104. It's trading at 98 right now. US dollar index. That's one piece of fiat versus others. It's not real value. It's just relative. All those things are indicating further fuel for gold because the governments will have to panic. Now, Powell has played this game of poker saying, oh, everything looks pretty good on the economic side. Well, today they just got a number that didn't look so good. And really inside the job market numbers, they don't look good because it's mostly government growth. Last job report was like 50% of the growth was state and local government, essential to the commodity, to the economy, right? Anyway, those data points will go fast to the south, and he'll have to change his mind. And already he has two, and there are probably 3 or 4 ready to come on board who want to cut rates now. And he's resisting them as well. Well, suddenly he's going to have to decide, does he want to go down in history as somebody who was fighting the president and even members of the Fed and was lagged to reality? Or is he going to finally get in tune and anticipate, which they're supposed to do, upcoming changes? And I think when they shift, especially when the stock market starts to break and create discomfort, emotion, the bond market remains at high yields, doesn't even have to go higher. But if it did go lower, I think it could be a mini panic. There's certain levels on T-bonds, you mentioned TLT, that if we drop below, and it's several points below TLT, that's all, it could precipitate a puke, a sharp, rapid, instead of an erosional weakness, a sharp panic. Now, undoubtedly the government will take military type steps to defend against that. So I don't know that the panic would last, but it would cause the government to be provoked, not incrementally, but, all of a sudden in this new direction, central bank. And that is what will inject gold. And I think all these things combined are essentially merely further fuel for the monetary metals waiting when they occur to cause acceleration in what's already going on in the monetary metals.
Fidelity says $4,000 gold possible as Fed cuts, dollar drops. Gold could hit $4,000 an ounce by the end of next year as the Federal Reserve cuts rates to cushion the U.S. economy. The dollar drops and central banks keep adding holdings, according to Fidelity International. Multi-asset fund manager Ian Sampson said the firm remained bullish on the precious metal, with some cross-asset portfolios recently increasing holdings as prices eased from an all-time high above $3,500 an ounce in April. The rationale for that was that we saw a clearer path to a more dovish Federal Reserve, Sampson said in an interview, adding that some funds had as much as doubled their 5% allocation over the past year. Also, August is often slightly weaker for markets, so more diversification makes sense, he said. Gold is up by more than a quarter this year as uncertainty around President Donald Trump's aggressive attempts to reshape global trade, conflicts in the Middle East and Ukraine, and central bank accumulation buttressed gains. Still, the metal has traded within a tight range over the past few months, with demand for havens cooling a little as some progress in U.S. trade talks eased fears about worst-case scenarios for the global economy. Fidelity's bullish outlook for gold is similar to that from Goldman Sachs Group Inc., which has made the case in recent quarters for an eventual rally to as much as $4,000 an ounce. Still, others are cautious, including Citigroup Inc., which forecasts weaker prices. Spot bullion was last near $3,315. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
I'm not so sure it's going to be energy leading this time. I think energy will be dramatic because we have a very clear, not a price level, but a momentum structural breakout that will occur if you close any month during this quarter at $70. Next quarter, it'll adjust down a bit. We're a few dollars below there right now, like pushing at it. You slip out and close over that average, which happens to be the 3/4 moving average of oil. There's a structure there, meaning when you plot an oscillator momentum chart of crude oil, you would see a trend line that you can't believe the precision of it. When you look at a price chart, you cannot see that structure. In other words, getting over 70 doesn't mean much when you look at a price chart. From momentum, it smacks you in the face. It says, I'm coming out of here. That will probably be very coincident with Bloomberg getting up over 106.50 on a monthly close anytime this year. Annual momentum of Bloomberg is positive, but in the recent pullback, it slipped back below its 3-year average, which in and of itself wasn't structurally important. It's just you cross below the average. Sometimes that's not important. It's the structure on the oscillator. But over the last 2 years, there have been multiple rallies by the Bloomberg, each like 4 or 5 rallies, that each time they get up to 106.50 to 108 in price, there's a ceiling. And they can't close a month over the 3-year moving average. It's a structure. In other words, if you looked at it, you'd see a structure you can't see so well on price. You close over that number, it's saying, I'm up out of the base. I'm breaking out of my base. I'm reasserting the ongoing trend, which commenced in October 2020. This is the next wave. And I think this time the Bloomberg will be in sync but lagged to gold. Like I said, commodities don't always move with gold. There are a couple periods in time they have. Stagflation in the late 70s. Stock market was a wasteland. Commodities exploded. On the tail end of gold, which was already exploding. Then again in 2006, 7, and 8, commodities exploded along with gold. And so forth. So I think they're about to get back in sync so that when you look at the horizon of categories and say, where was the best place to put my money? Well, there's a slightly awakening investor crowd in the U.S. that's finally realizing maybe gold. I think Europeans and Asians have long known this. But the Americans, for some reason, are lagged to that. They're very underinvested in gold and gold-related. Gold has been the ongoing place to be, but suddenly you'll look at commodities and say, what's going on here? I thought Trump was going to keep it under control. And it would ambush people intellectually and emotionally if that category started to turn up for no particular reason, other than, of course, it's cheap historically, and the money flow from the central banks goes somewhere. And investors finally say, hey, I think I'm going to put it in commodities. They're cheap. But also look at commodity stocks. That's a great place to be, I think. Agricultural related, energy related, but wait for the Bloomberg breakout, and we time that, and wait for the crude oil breakout. And they're literally just a few percent above where they're trading right now. And I don't think they need a headline to break out. They'll do it on their own with no particular reason. Then you'll start to gush, and then maybe some headlines will occur. But I think that's a place to put money right now. If you gold, silver primarily, secondarily, commodity assets.
What do you think of Michael's take? Do you agree with him? Or on the contrary, do you think he's just a moon boy? Post your honest opinion in the comments section down below and share with the stackers your price prediction for gold and silver. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.